Hi, everybody. I'm Ken Kirschenbaum. Thanks for joining us today. As you know, Kirschenbaum and Kirschenbaum hosts a series of webinars. This is the 2025 pre-ISC webinar grouping. Today is Mitch Reitman from the Reitman Consulting Group. Mitch is the preeminent tax authority, accountant for the alarm industry. And quite honestly, I don't know why he's not your accountant if he's not. If he is, then great. Take advantage of this free hour that you got him on. So Mitch certainly is my go-to guy for any tax issues that come up, accounting issues. He also is does due diligence on deals, complex deals or not so complex. He'll be happy to do those as well. He also does valuations, complex valuations. So if you're looking to spend more than the $950 that you might spend with me, go to Mitch. He'll be happy to give you a complex evaluation, and he's prepared to go to court. He loves to travel, as all associations know. He runs to every meeting he can go to. That's why he's prematurely white-haired. But anyway, we're going to hear from Mitch today, and as I said, I have full confidence in him, and you should too. Mitch, I'm about to make you the presenter, and your screen's going to come up. Please write your questions that you have. I'll read them to Mitch. Maybe I'll interrupt him, but otherwise I'm going to wait till the end and handle all the questions at the end. So here we go. Mitch Reitman is now the presenter.
All right, Ken, thank you. And let me get my screen up here. And I'm hoping that the screen's coming up. Are you seeing the screen now, Ken?
Yes, you're good to go.
Okay, good. Well, and as Ken said, we do mainly tax work, tax preparation and representation. We're pretty much authorities on not only sales tax in all 50 states, but also how it affects the alarm industry. We're going to talk about that today. And just real quick, for valuation services, we do a lot of divorces, partner disputes, and estate valuations. If it looks like it's going to end up in court, there's certain rules you got to follow and certain things you have to do. So that's why people come to us, so that they don't have to end up getting hung up in court with a bad valuation or a valuation that can't be supported. So we're going to get started here as soon as I can get my computer to switch to the next slide, which it doesn't seem to want to do. Is it showing up right now?
Yes. Go to start my slideshow. Start my slideshow,
Okay.
and then just
we're starting it, and here we are.
And just use your hour to go through it.
Okay. So is it coming up now and working?
Yes. Yes.
Okay. And for some reason, this is the wrong slideshow. So hang on a second.
Make sure Mitch doesn't send in the wrong tax return when he's working for you, okay?
This isn't it either. Hang on a second. Something is really wrong here with this today. So let's get it in the right slideshow. Okay. Now, are we working, Ken? Are we working? Okay.
Yes, you're good to go. Let's go.
Talking about sales tax, states generally tax the sale of tangible property. That's stuff you can put your hands on, except there's some differences in the alarm industry. We'll talk about that today. And sales tax is actually a sales and use tax. So it could be something that you're selling to somebody. It could be something that your company's buying for their own use, and we'll get into that. And services and intangible assets are subjective. That means that different states treat them different ways depending on the nature of the services. We'll get into that. And understanding the nature of the services is critical. So what is the law? The sales tax law usually comes out of state legislative bodies. They make the law, and it's usually fairly vague. So the departments of revenue interpret it, but they usually interpret it the way they want to interpret it. So this can be biased. So taxpayers will from time to time contest these rulings in court. It could be an audit where they don't agree with the auditor. They could not agree with how the state's interpreted. And so they'll either have a court case and the court will decide, or some of our clients obtain technical rulings. We've done that a couple of times now from people that have written into Ken's daily email. One asked if monitoring was taxable in Indiana a few years ago, and we got a ruling from the state that it's not. And one sent an email into Ken about a year and a half ago, advising everybody that monitoring was now taxable in Kentucky. And my question was, Kentucky taxed intrusion monitoring. What about fire monitoring? So I spent a year and a half with the state of Kentucky, probably 18 to 20 meetings and letters going back and forth. And they finally agreed that under certain circumstances, fire monitoring is not taxable in Kentucky. So sometimes if you get a technical ruling, you can rely on that. So it's not as easy as just what the law says. And so most states follow the contractor rules, and the contractor rules define who the end user is. The end user is usually who's going to pay tax on a transaction. So monitoring may be a taxable service, depending on the state, depending on the type of monitoring. Sometimes you'll see a state considering Berg monitoring as a taxable, as an installment sale. Where that goes back to was in the 90s, the state started catching on to the fact that a lot of companies were selling an $800 system for $100 down and $35 a month. And they said, hey, wait a second, $700 of that was an installment sale. And we never got our tax on that equipment because monitoring wasn't taxable. So quite a few states like Texas and just recently Kentucky went back and started taxing monitoring on the Berg side to make sure they caught those installment sales. What that did was it caught the companies that were installing the full price systems at $5,000, $10,000. Now their monitoring is taxable even though there wasn't an installment sale. So your accountant should be leery of that. Most of them aren't. Most of them don't understand what you do. And you can get caught not charging tax on something you should have charged or charging tax on something you shouldn't have charged. And leases can be subjective. Different leases are treated in different ways in different states, depending on the terms of the lease. So it's really important to make sure you structure your leases properly and charge taxes. Otherwise, you can get in trouble there. So the contractor's rules is something you hear a lot about. And a lot of CPAs just assume that you're following the contractor's rules because they assume you're a contractor. So if you install something for a lump sum, cost plus, fixed fee, guaranteed price, or a fixed time and materials amount, your company is the end user of the tangible personal property. And typically the labor on a new commercial install when it's new construction is not taxable. But some states adopt some of the contractor rules and don't adopt other contractor rules. So if your CPA is just assuming that you're subject to the contractor rules and you're paying sales tax on the materials when you pick them up and not charging your customer anything, you need to be sure. We just went through representing a client on an audit. They get bad information from their CPA, didn't charge sales tax and over $1.4 million of new construction labor for alarm and camera and access control systems, and ended up with a $120,000 tax bill. They should have charged their customers. They didn't know any better. The state's not giving them any slack, and now they're faced with a $120,000 bill they're going to have to pay. So make sure that you understand how your state applies the contractor rules to what you do, and make sure your accountant really understands what you do. So if it's a retail sale plus, so if it's a retail sale where you're selling equipment to the customer, and that would mean an itemized invoice where you're itemizing materials on the invoice, Then you have to charge the customer for the marked up price on the contract. And the customer's got to assign title to and have risk of loss for the materials. This is another reason not to just generalize and think that you can pay tax when you pick the equipment up at your wholesaler and not charge the customer. So fixtures. Every state defines fixtures in a different way. So, but when you're installing fixtures, and that means something that's permanently attached to real estate, you're the end user and you pay sales tax or surtax on the purchase of the fixtures and the installation materials. You don't collect sales tax from the customer. When you're deciding whether an item is a fixture, consider the installation agreement, the method of attachment, the intent of the parties, and permits and licensing. And one more thing I would offer up is, what does the case law say? In Florida, it's really strange that a fire alarm system is not considered a permanent attachment to real estate, not because it isn't, or not because that makes sense, but because the Florida Supreme Court decided that in an appeal. Now, I think they're wrong, but it's Florida Supreme Court, that's what you're gonna have to do. So the contractor rules on tangible personal property. So if you install tangible personal property that remains tangible personal property, you must collect sales tax on the total charge. The method of installation is a factor of determining the taxability. For example, a mailbox that's bricked into a post beside the road is an improvement to real property, so you're the end user and you pay the tax. But if it's a mailbox that's attached to a house or screwed into a wooden post in the ground, it's tangible personal property, so you got to tax the customer. Again, another reason to make sure that your accountant understands the difference between tangible personal property and an improvement to real estate. And then, of course, fire systems, there's special rules for fire systems because most of what you do in a fire install is permanently attached. But then again, you got the state of Florida saying it's not. So make sure that your accountant knows the rules in your state. I hate to make this sound too complicated, but it is. And if you get caught and you don't treat this right, the state is going to go after you for the tax because you're the easy target. So if it's a lump sum contract, typically the contractor is the end user and the customer pays the tax on the time and materials. But if it's not lump sum or it's a time and materials contract, then the customer may be liable for the tax, maybe the contractor. But then again, this is where you need to talk to your accountant, make sure you're structuring your invoices properly, where you're not charging for stuff that you shouldn't be charging for or not charging for stuff that you should be. So if it's cost plus is fairly simple. If you itemize your invoices and sell the items to the customer on an itemized invoice, alarm panel, $400, PIR, $200, camera, $400. The customer is the end user and you have to collect sales tax from the customer on the marked up price. So how to get legal? Any contractor that sells tangible personal property, and I can't imagine an alarm company that doesn't, or performs real property contracts and sells tangible property at retail, or fabricates items for use in real property and contracts and owes use tax on the fabrication cost of the items, must register with the Department of Revenue in most states. One of Ken's guys wrote in that he doesn't bother to get a sales tax permit, so the state doesn't know that he's out there. He just pays tax on all his materials when he picks them up, and he doesn't have to worry about it. This is wrong, and they're eventually going to catch him, and they're going to make him pay tax on everything he's sold for the last 3 years. They're not going to care that he's paying a distributor. So make sure that you register with the Department of Revenue. That usually means getting a sales tax permit. Yes, you're going to be in the system, and yes, you're probably going to get audited, but if you don't do it, it's even worse. So what are the sources of the sales tax law? Like we spoke about before, there's a state tax code, and then the state will interpret or rule what they believe the sales tax code is. Then there are administrative court decisions all the way up to the Supreme Court of the state, and their technical rulings or advice. So one thing that was very important and very critical and kind of earth-shattering the sales tax business was what's called the Wayfair ruling. And in 2018, the U.S. Supreme Court ruled in a 5-4 decision, so it was close, in South Dakota versus Wayfair, that states can generally require an out-of-state seller to collect and remit tax on sales to in-state customers, even if the seller has no physical presence in the consumer state. In doing so, the court overruled 50 years of its own precedent. The decision allows states to define the sales tax threshold which will trigger this collection requirement. What was happening was internet sellers were selling into states where they didn't have a location and not collecting sales tax. And the merchants in the state said, this isn't fair. We're having to collect sales tax. And here's Wayfair selling furniture and selling clothing and stuff like that to people in the state and not paying tax on it. And the Supreme Court said, you know, the internet's changed in the last 40 years, 30 years since they've looked at this before, and said you have to start charging tax. So if you are not going into the state but selling equipment into the state, then you could be subject to the thresholds, which are the economic nexus. And here's an example of economic nexus. In Alabama, you have to sell $250,000 in sales as of 2018. In Georgia, it has to be $100,000 in sales. North Carolina, South Carolina, $100,000. Tennessee was $500,000, but effective in 2020, it's $100,000. Now, these are changing and they're going down because the state is trying to put more and more people in the system. So make sure if you're selling in another state, you're aware of it. Here's the other problem that alarm companies have that a lot of accountants don't understand. Many states require that an alarm company have a physical presence in the state to be licensed. If you need to be licensed in the state you're doing the work in, whether you're there or not, then you probably have physical nexus. Physical nexus means that you've gone into the state, somebody has been in the state doing work directly. And one of the problems of licensing laws, for example, in Texas, somebody in the state of Texas has to vouch for your alarm license. So you do have physical nexus. And most states do not allow you to contract away licensing requirements. So if you're in Alabama and you're doing work in Mississippi, most states won't let you hire a Mississippi licensed company to do the work. You've got to be licensed as well. So one, talk to Ken and get an idea of what the licensing rules are. And if you have to have a physical presence in that state, you have a physical nexus, and you better charge and pay taxes and follow the tax rules, or you could get into a lot of trouble. We're representing a few companies right now that went into other states and did work. One of them used entirely subcontractors, and the state's coming after them for sales tax, and they're going to have to pay it. The only situation where I've seen that physical nexus didn't apply in any of these cases we're working is a company that sent access cards for a parking garage where they didn't have to be licensed to put the parking gate in. And now they're not in the state physically anymore, but they're mailing boxes of access cards to the parking garage owners. And in our opinion, that is economic nexus, not physical nexus, because they're no longer going into the state. But if they make a service call and go in there, then they'll have physical nexus. But if they use a subcontractor, since it's not alarm work in those states, they don't have physical nexus. So, Ken, have you got any questions on sales tax so far? We're about to go into the entity selection part.
Let me check. Nope. Personal property. When did Florida Supreme Court designate fire alarms tangible personal property? Well, first of all, your fire all-in-one states that the fire alarm remains personal property. That has some persuasive argument. It's not decisive on the sales tax department, but the contract itself says it remains personality. Certainly, anything that proves in that can be removed, that's going to be personality. Arguably, the wiring might be considered permanent, but that's the answer to that. Do we need to charge a sales tax on the lease of mobile surveillance trailers in Pennsylvania?
Ken, let me go back to the question about the first question is when they decided it was tangible personal property. There's case law, I don't have it in front of me, but we had to look it up for a client, and their CPA in Florida got into an argument with me, and she said it makes no sense that a fire alarm system that's installed in a building, the access control system is considered an improvement to the building. Why wouldn't the fire system be an improvement? Like I said in my presentation, because the Florida Supreme Court said so. It didn't make any sense. The case was a situation where a fire alarm contractor installed a fire alarm system in a building, and they paid the tax on the equipment and didn't charge the customer tax. And the state said, no, you should have charged the customer tax because we think this is tangible personal property. Now, with Ken's fire all-in-one, it would be tangible personal property because you're defining it as that. And it went all the way to the Florida Supreme Court. and the Florida Supreme Court said, nope, this is tangible personal property. Typically, tangible personal property is something you can remove easily. A fire alarm isn't something you can remove easily, but Florida Supreme Court says it is, it is. And so that's the issue when you're having to follow case law. The law may make sense. The state interpretation may be vague, but once a court has ruled on it, especially when it makes it to the Supreme Court, you're not going to have any luck fighting that decision. So go ahead on to the next question you had, Ken.
Do we need to charge sales tax on the lease of mobile surveillance trailers? Now this question is for Pennsylvania, but there's a lot of mobile surveillance trailers elsewhere. Texas has loads of them, for example.
For example, in Texas, if you're doing any kind of work that's regulated under Occupations Code 1702, which is the burglar alarm ordinance, that anybody that does intrusion alarms and any kind of burglar alarm work, access control, or cameras that can be monitored off premises, that's all subject to sales tax. So a trailer in Texas would be 100% taxable, whether it's a lease, whether it's a sale, anything, even the monitoring is taxable. In Pennsylvania, I'm not certain. What it's going to come down to is whether or not they tax the type of service that the trailer is providing. That's going to be the overriding consideration. Then if they don't, and it comes down to whether it's a lease, then it's probably going to come down to whether it's a capital lease or an operating lease. An operating lease is where you pay a monthly amount every month for something and you never take possession of the equipment. Most of Ken's leases are that way. The customer never gets possession of the equipment. But if it's what's called a capital lease, then the customer gets possession of the equipment at the end of the lease, or the equipment's not worth much at the end of the lease. So
yeah, none of my contracts read that way. None.
Okay. Who ends up with the equipment at the end of the lease, Ken?
There's no end of the lease. Equipment can be removed.
Okay, so the alarm company.
Although my contract has an interesting provision that allows the alarm company to sell the equipment to the lessee at the end of the lease if it wants to, at its option, and the purchase price for that sale is going to be the agreed value that they've already provided for in the contract. And the question then would be, is a sales tax due on that sale? And if the sales tax was due at the time the equipment was first installed, then it's going to be due then and at the end of the lease, the same situation.
And so every state has rules that sometimes will override this definition. And typically what's called an operating lease, where the company continues to own the equipment, is the company's intention to get the equipment back at the end of the lease. That would be, for example, my postage meter here in my office. I don't own it. There's no way I can ever own it. And unless the state says something specifically about it, in Texas, it's specifically taxed. There's no tax on it, but in Texas, they specifically tax leases of postage machines. But if it doesn't say that, an operating lease may or may not be taxable. But what's called a capital lease is where the equipment's actually being sold to the customer. So if you buy, let's say, a computer, and the value of the computer is $2,000, and you're paying $200 a month for 36 months, you're going to pay $7,200 for that computer. So you've effectively bought that computer. If the lease says, when it's over, the customer can keep the equipment, the customer can pay $50 for the equipment, it doesn't say that the company can get it back, then if the customer ends up keeping it, then it's a capital lease. So you've actually sold it. So most states will tax the lease payments on that because they're really installment payments. If the purchase option, like at the end of the lease, you can pay $20 and own it, then that's a sell, an installment sell, and they're typically going to tax that, but then again, it goes state by state. Or if the ending value of the asset is less than 2/3 of the present value of the asset per the lease, then it's also considered a sale. You've really bought that. Some vehicle leases, most vehicle leases are capital leases. You pretty much rent the car and the leasing company gets it back. But if it's something that's a 6-year lease and you're going to pay for a $20,000 truck, pay $45,000, it's pretty much considered a capital lease, and you bought it and they tax it. But every state has their own way of looking at different types of leases. And what's very critical is you need to understand the sales tax rules in your state. And if you're going to do a lease with one of Ken's leases, you need to have your accountant explain to you the best way to structure it. And I don't understand why people want to pay tax on equipment when they purchase their distributors and not charge their customers. You always want to try to figure out a way to have your customer pay the sales tax, because that is 8.5% of profit that you're not losing by paying the sales or whatever the sales tax rate is in your state. So the best way to do it is to join Ken's concierge program. And when you do a lease for one of these big customers where you're doing a lease, talk to your accountant or talk to us first and say, this is the way we want to structure it. And then talk to Ken and say, okay, this is how it should be structured for sales tax. What do you think, Ken? How do we rewrite our lease to make sure we conform to this? Because again, it's always better to have your customer pay the sales tax than have you pay the sales tax and not push it forward to your customer. It just makes no sense. And in Florida, if you look at a lot of the decisions on residential repair and residential installation and residential service, Sears Roebuck was the plaintiff in the case, taking it to the state, because at one time in the 70s and 80s, Sears was the largest home improvement company and largest appliance sales company in the state of Florida, and they wanted their customers to pay the sales tax. So you'll run across all this case law where Sears has said, for whatever reason, we think the customer ought to be paying the sales tax on this, whether it was a service call or whether it was an installation or whatever it was. And they had more resources than anybody else, and they won the state of Florida. And so now you're going to have to charge tax on your residential service call, depending on how you structure it. So,
Well, Mitch, let me explain
structure your agreements properly.
This is really quite simple. First of all, when it comes to collecting the sales tax and turning it over to the taxing authority, you're simply viewed as the agent of the taxing authority. That's why you face personal exposure, and it's non-dischargeable in bankruptcy court in the event you fail to collect and turn over. It's treated as a fraud, basically. You're treated as a fiduciary undertaking to collect this tax on behalf of the taxing authority and then turn it over. The other point I want to make very quickly is understanding this concept of why is tax owed? Tax is owed generally when you're dealing with the sale of personal property, whether it's a over-the-counter sale or something sold somewhere else that is not intended to become a permanent fixture in to real property. If permanent fixtures to real property are generally treated as capital improvements, and there's no sales tax, and you get to depreciate it. The owner gets to depreciate it over a period of time, but they can't deduct the cost when they first put it in. Sales tax is on personal items, personal services as well, and alarm industry is basically treated that way. When you have gray areas, what's a fixture, what isn't a fixture, very often the contract can add could make a difference in terms of how it's going to be viewed. So in the alarm industry, it's no doubt that was used when the courts considered, is this personality or not personality? And think of it in terms of delivering a television set, maybe screwing it to a wall and plugging it in. That's not a fixture. It can be easily removed. On the other hand, you install a lighting fixture in a ceiling, and it's hardwired. That's not so easily removed. That probably is going to be deemed a fixture. But there's gray areas in the alarm industry. Even those complex big panels that you see screwed to a wall in a building, a couple of screws and you can remove it. Yeah, it's got a bunch of wires to it, but for the most part, all those wires are low voltage, and also wiring installed by the alarm company, and alarm company claims they own that too, and they're going to remove it when that lease is up. That's what gives you a big heads up on a fire alarm lease, by the way, that system always belongs to you. When you talk about these trailers, of course, they are for sure non-attachable fixtures. They're not fixtures at all because most of them aren't even attached to a real property. They're just sitting on the property. Okay, Mitch, I'm going to give it back to
So
you.
let me,
There's a couple more questions. Let me see if I can ask it. So wait a minute, where are they? Oh, that's the one that's coming up here. Yes, wait a minute.
Ken, while you're getting your common law question, let me clarify one thing that Ken said. The sales tax in most states, like we said at the beginning, is a sales and use tax. So if it's personality, Ken was correct. You're selling it to the customer, and the customer will typically be the one that's liable for the sales tax. And you're collecting it from the customer, and you're remitting it to the state. And that's why when we talk to the sales tax auditors and those people, they call that money trust funds. It's being held in trust by you to be paid over to the state. Now, when it's a fixture, most states consider your company the end user. It doesn't mean there's no tax on the materials. It means that your company is paying tax at the materials when you pick the materials up. And depending on the state, whether you resell them at the same price or whether you don't list them on the invoice or however you handle it, a lot of times you are the end user and you're liable for the tax. And the big misconception a lot of companies have is as long as they just pay tax at their distributor on all the materials they buy at whatever price they pay for them, they're okay. And that's not going to work when it's personally, when it's not a fixture and you're reselling it to the customer. The state is going to expect you to charge and collect tax from that customer. So be very careful about that and understand what your state says is personality and what is not personality and what is a fixture and what's not a fixture and whether labor is taxable on the work you're doing. Typically in most states, now Texas is an exception, but most states, new construction, the labor is not taxable. But once the building is up and going and once equipment is in there and something's being replaced or upgraded within certain limits, that's considered a repair, and most states are going to tax the labor on that. So again, it's very important to understand what is and isn't taxable. The easy way to handle situations where your company is the end user is just not pay tax when you pick it up at the distributor. And then on your monthly sales tax form, it's going to ask you for a line item for items for which your company was the end user, and you will pay the tax there. That way you don't have to put it into your accounting system. This is taxable if it's this type of install. It's not taxable if it's not. We pay tax here, we pay tax there. Work it out when you do your sales tax return, not when you're picking it up your distributor. This is the biggest mistake I see people make, is they just write a check to their distributor for sales tax and everything, and they think that's going to cover them. And then the auditors roll up and they find out they owe $100,000 in sales tax. So maybe, Ken, you've had a chance to find your legal question.
Yeah, Mitch, you need to, first of all, you need to move that box, which is blocking your PowerPoint.
I'm trying to get it off of there, but it doesn't seem to be going away.
Well, just click on the top of it and move it to the right. That should work.
Okay, let me see if I can get it out of there.
Because that's causing a stir.
Yeah, I'm not able to move the mouse on it. Let's we'll just move and go as we're going.
Maybe move the PowerPoint. See if you can move the PowerPoint over by.
I can't get the mouse to work on this machine right now.
You can't get the mouse to work. Okay. Oh. Okay. Well, anyway, to answer the question that number of people, can the box be moved? The answer is apparently no. Sorry. Are wireless alarms tangible? What does that? No, tangible is not the right question. Of course they're tangible because you can feel them. It says tangible and intangible. So yes, they're tangible, and yes, they're taxable too.
And whether they're taxable to your company or to the end user depends on the state and depends on the type of the installation and a lot of factors. If your accountant is telling
wait, Mitch, wait a minute. What do you mean by that? It's always, the sale is always taxable, and the sales tax is supposed to be paid by the end user.
If the state Ken, that's what we just talked about. The state considers your company the end user, then it's taxable to your company. If the state
Well, that's when you buy it. That's when you buy it. So that means you're taxed when you buy it from your supplier. You pay a tax, and then there's no tax to the end user. That's what you're saying.
Unless the state considers your end user the taxpayer, in which case you got to charge the end user. So that's why I was saying, just when you buy everything at a distributor, don't pay tax, and then work it out on your sales tax return and pay tax on what you're the end user for, and charge tax on the stuff your customer's the end user for. If your accountant can, give us a call.
When you're buying wholesale, you're generally not paying a tax. The alarm company doesn't pay a tax on the equipment, and then they charge the end user for the sales tax, assuming they're in a state that has a sales tax. Not every state has sales tax.
But Ken, the issue here is a lot of people call me, and it just surprises me, and tell me they've been advised by their accountant just to pay tax on everything when they pick it up to the distributor. And even one of the people that wrote into your to your email column was saying how brilliant he was, that he's paying tax at the distributor, and the state's leaving him alone. Well, at some point they're not going to leave him alone, and he's going to find out the hard way. He should have been charging tax to his customers.
Right. And the fact that he was paying a sales tax to the supplier isn't going to do him any good.
It blows my mind. It blows my mind how these guys operate until they get caught. And the states want money right now, and they're going after people. We've got 17 active audits right now in Texas alone for clients that weren't ours when they filed the wrong returns, when they made the mistakes, but now they're in the hole, and we're trying to see how much we can mitigate this.
We're spending a little bit too much time on this topic because we got a lot of other stuff.
Let's move on to entity selection.
Wait, let me ask you a couple of questions before you move on. I think you might have answered this. When did Florida Supreme Court designate fire alarms?
I've got to go back and look at the case law, Ken. It was back in the 90s.
All right, it doesn't matter. They did it.
Yeah.
Do we need to charge sales tax on the lease of mobile surveillance trailers in Pennsylvania? I asked that question that got started here.
Yeah.
Mitch may not know the law in 50 different states, so we can't hold him to that. He can find out.
I do. In an hour, I can find it out, and that person.
Yeah, an hour, but not now.
Find it out for him.
Is monitoring service taxed in Georgia? If sales tax is collected and paid at time of installation for the equipment portion, what was the distinction that required charging use tax on cost versus retail on parts? Look, some of these questions you have to appreciate that as an authority on taxation throughout the United States, which he is, doesn't mean he has the answer on the tip of his tongue about every state. Just like I can't answer a question about every state. The difference is we can get the answer. We have to be given the opportunity to get the answer, and we can get it relatively quickly. He can get it quickly because he knows where to look and what to look for. That distinguishes him from your accountant that doesn't know what the issue is or where to find it or look for it or doesn't want to. All right, that's the difference. Okay, so the answers to these questions, maybe he knows off the top of his head, but if he doesn't, you guys got to call Mitch after this. Okay, and well, come and see him at ISC, by the way. He's going to be at ISC. We're scheduling appointments for him. You contact Kathleen Lampert in my office. It's on every one of my emails. Contact her. You get a free meeting with Mitch. Take advantage of it. That's the best thing you can do. What was the distinction that required charging use tax? Not every state has a use tax, folks. So on cost versus retail on parts, what tax do we charge the customer for monitoring in a state that collects tax for monitoring? What do you mean, what tax? You charge a tax that the state. All right, Mitch, do you understand those questions and what the answer is?
Yeah, and the answer to all these questions is that I pay a lot of money, over $10,000 a year, for a service that collects all the rules, all the case law, all the appeals, all the private ruling decisions, all the advice from the states. And we can look this up. It takes us about an hour, but we only do this for our clients. If your CPA doesn't know how to tell you what is and isn't taxable in your own state, you really need to rethink where you're getting your advice from. This is something that we don't take lightly. When a client of ours calls and asks us if something is taxable, for example, the guy a few years back, Ken, that asked if monitoring was taxable in Indiana, the law is very vague. And it said that they tax the transmission of data from one location to another. Well, monitoring isn't transmission, it's receiving. So I looked up an answering service. Answering service isn't taxable in Indiana. So I called the state, the practitioner hotline. A lawyer called me back the next day and I explained to him what was going on. He called me and said, we took a vote. A 20-person committee were split 10-10. So I said, I'm going to send you a request for a technical ruling. I sent them a request for a technical ruling. 6 weeks later, they wrote me back and said, not taxable. So I published it on Ken's site, and I got calls from probably 8 or 9 CPAs in Indiana trying to explain to me why it was taxable. Well, I've got a letter here from the state that says it's not. They didn't understand what monitoring was. And that's what's important is if your accountant doesn't understand what you do, you need to educate him what you do, or you need to call us. Every state's got their own rules. Every state's got their own type of work. In Kentucky, the question that Ken had a year and a half ago was the guy thought that monitoring was taxable. Well, it turns out after 18 phone calls and meetings with the state of Kentucky and letters going back and forth, they've advised me in a letter that I published on Ken's column that only berg monitoring is taxable. Fire monitoring isn't taxable, but they have certain rules that you have to bill it as and certain ways you set your billing up. Not everything is easy as black and white in a book. You've got to understand how to.
We can get this one. What tax? I don't know if we can answer this one. What tax rate do we charge the customer for monitoring in a state that collects tax for monitoring?
It depends on the state.
Whatever the rate is, that's what you charge them. Then the net. But the follow-up is the tax rate for the state the alarm company installer is in, or the state, or they want to know what tax are they collecting, where the central station is located or where the end user is located. The answer is where the end user is located.
And typically the law is going to be vague about that, and the interpretation is going to be vague. So we're going to go through the case law, and somewhere along the way, somebody's gotten crosswise with an auditor, and it's gone to court, and the court's decided, and that's what we're going to do. In Texas, for example, it's very vague whether you charge the tax for monitoring, but there's case law where they said you can charge tax for monitoring where the primary location of the company is. That's in Texas. It could be different in Oklahoma. It could be different in Kansas. It could be different in Kentucky. You've got to go through the case law until you find a case that's on point with what your situation is. And then you can rely on that, or you can send off and get a technical ruling from the state. And we do that all the time. And once you get that technical ruling, that is the way that the state's going to let you handle it. And it's a get out of jail free card.
Okay, well, generally you're looking at three possibilities, I guess, when you look at it. One is, where's the customer located? Where are you located? Where's your main office? And where's the central station? What state are they in? I don't think we're talking about where the central station is.
It'll very rarely be where the central station is located.
Right.
I
So
can imagine that.
you're pretty safe. You're pretty safe if you figure it's going to be the end user's state. Assuming the alarm company is allowed to do business in another state, we are New York. We are also licensed in New Jersey. Do we charge New Jersey sales tax? The answer is yeah, if it's a New Jersey customer. Even same state. We are in Rockland County. We have customers in Westchester County. Which tax rate do we use for monitoring? Where the customer is.
Well, for monitoring, Ken, New York may let you do it where the company is, but for a service call or an install, typically the state's going to make you charge tax where the service was performed. But that may be the New Jersey one. They're very specific, and somebody asked this on your website before. New Jersey is very specific. If you're doing business in the state of New Jersey and you have an employee that sets foot in the state of New Jersey, you have to pay. You have to have a New Jersey tax account. You have to collect and you have to remit tax. And that answers that question. If you're in New York and you're making a service call in New Jersey, that's taxable in New Jersey.
Are camera systems considered alarm system category? He has okay. As you all know, I use the word alarm system to include cameras, access control, anything you're doing. That's how I call it in the contracts. But and generally, you're almost always going to find under the definition of engaging in the alarm or security business, you're going to find all the different types of systems grouped in there. So they don't differentiate between camera access control, intrusion systems. They're all considered security systems and electronic security systems. And we're still referring to them as alarm systems, almost in the same way we're still referring to camera systems as CCTV, which it's not anymore.
Let's wrap up the sales tax thing, Ken, because we have another section to get onto. But let me just make a general statement about these questions. Your CPA should know this, and if they don't, you need to think about who's doing your taxes. We've had numerous situations in Texas. That's what most of the audits we're having right now is because CPAs didn't understand that access control systems in Texas are considered intrusion systems and require a Berg license, and they're 100% taxable no matter what. Camera systems that can be monitored off premises are considered intrusion systems and Berg systems, and they're covered by Section 1702 of the Occupations Code. They're taxable. We have numerous people that have come to us because their CPAs didn't know, gave them bad advice. Now they're writing big checks to the state because of this. One situation where our knowledge helped us was that little indication in the Texas burglar alarm code. It says if the camera system can be monitored off premises, and we had one, it was an $80,000 install for a mini warehouse, a storage place, and there was no DVR in any of the invoices. Now, there probably was one out there, but we didn't see one. So we told the auditor we didn't think that could be monitored off premises, and they let them out of that. That saved my client about $7,000 in sales tax they hadn't collected. So you need somebody that understands the nuances of the alarm code. But Ken, I want to get on to the entity selection. We can get through fairly.
Just two more things, Mitch. Our CPA told us that we need to charge the tax rate where the installer is located. I wouldn't buy that. I would go where the installation is, not where the install is located. But again, you'll have to deal with that on a local basis. And somebody pointed out, Mitch, that you don't have your actual slideshow on. You have something else on, presenter view on, which is why you might be having a problem.
Yeah, and what's happened is my mouse. Oh, here's my mouse has gone back, so maybe I can get it to work. I'm afraid the whole thing's going to go down. But
can you please clarify taxable materials?
We're down to 10 minutes.
All right. Can you please clarify taxable materials and taxable labor for wireless residential alarm or commercial hardwire in New York? Listen, we treat it as fixture. If it's as not a fixture, rather as personalty. Therefore, technically, you charge for it as you would for the sale of any personalty that's being delivered. That's it. That's the answer in New York.
Unless there's case law that says otherwise, which I don't know. But if you're my client, I would look it up for you. That's the thing here today. You can't just. I think Ken's right. He probably is right. But like in Florida, you can't make assumptions based on common sense because
no, you can't do that anywhere. Never mind Florida. Do camera systems require a license like burglar alarm? Yes, they do.
In what state?
It's not. That's not a tax problem. Since there's a monitoring included with cameras, do you need a license? This is not a licensing webinar, folks. You got to call me on that or listen to a licensing webinar. We charge regular tax according to the state the installation is in for equipment, service, etc. It's just been the central station monitoring that's been our challenge. If your state requires you to charge, you're charging for the monitoring, not the central station. You subbed out the central station monitoring. So if you have to charge for monitoring as a service you're providing, then the answer is you have to charge it and collect it and turn it over to the taxing authority. And that's almost always going to be in the state where the customer is located. You have to look at that state. You also have to look at your own state. Usually it's the same state, so it's not going to be that much of an issue. Mitch, you got to move it along. You only got 9 minutes.
Let's go on to this entity selection. Can we do that, Ken?
Yeah, let's move on.
Okay. So entity selection. This is a question that Ken had a couple of weeks ago, and it's something that a lot of people don't understand, and their CPAs don't understand either. So businesses generally operate as sole proprietorships, general partnerships, or corporations, or what's known as LLCs. We'll talk about that in a minute. But a sole proprietorship is simple to form, but it has generally no limitation liability. It typically, it has to have one owner. And if the tax return is a Schedule C on your personal tax return, most are very small businesses with questionable viability and questionable as to whether they're even really a business. And the IRS looks at these very heavily because many sole proprietors deduct personal expenses and they're really not a business. And the IRS is looking at sole proprietorships because many proprietors are actually employees and they're taking expenses that maybe they shouldn't be taking, maybe the employer ought to be taking. So the next is a general partnership. It's simple to form. There's generally no limitation liability. A partnership by definition has more than one owner. We have a client whose tax preparer tried to let a single person file a partnership return. That can't happen. They can be simple, they can be complex, and they're actively looking at these entities because partnerships can easily be formed and many are tax shelters. So having a partnership is a red flag to the IRS. And owners who work for a partnership, this is very critical, cannot take a salary and must pay self-employment tax on all of their proportionate income. And that's what a lot of guys don't understand when they get into a partnership. So a C corporation is an actual legal entity and it requires registration in most states. It offers legal protection. It can have one or many owners. And the C corporation files what's called a corporate return with the IRS, a Form 1120. It can be simple or complex. There's less IRS scrutiny of corporations because most people that have C corporations are earnestly doing business. It has very few restrictions on number or type of shareholders, but is subject to double taxation. And that's a whole other presentation, is what happens when you go to sell your big intangible asset, which is your accounts, in a C corporation, and you find out you got to pay tax twice. Now, an S corporation is an actual legal entity, and it requires registration with the state. One misunderstanding a lot of people have is there's no legal difference between an S and a C corporation. Your attorney files your corporate status with the Secretary of State. The S designation is between your corporation and the IRS. It's not a legal difference. It's just exactly the same in the eyes of the law as a C corporation. And it can have one or many owners, and it files a corporate return, an 1120S. It can be simple or complex. There's some restrictions on number and type of shareholders. They have to be individuals. They all have to have the same class of stock. They have to be less than 100 shareholders, and they have to be U.S. citizens or resident aliens. They can't be people that are foreign nationality that can't be in the U.S. And it's not typically a taxable entity. That's the big difference and why S corporations are better for an alarm company. They don't pay tax. So when you go to sell your accounts, the corporation doesn't typically pay tax except at the state level, and the shareholders pay the tax. And the owners that work in the business have to take a reasonable salary. They can't just take the residual income from the corporation. That's a big misunderstanding a lot of tax preparers have, is people try to avoid paying into FICA by having an S corporation and not paying themselves a salary. So a limited liability company, LLC, we see these a lot. And the big problem with them is that they didn't exist back in 1986 when they rewrote the tax code. And so the IRS doesn't know how to deal with them. So it's an actual legal entity. It requires the registration of most secretaries of state. It provides similar benefits as a corporation. It can be simple or complex. Depending on how you report, there's some restrictions on the number of shareholders or members. And it's not typically a taxable entity, doesn't have double taxation. So the tax treatment of an LLC. The tax code doesn't recognize LLCs. It didn't exist in 1986, and they haven't rewritten the code to include them. They're called disregarded entities. So they have members instead of shareholders. A single member LLC is taxed by default as a sole proprietorship. Multi-member LLCs are taxed by default as partnerships, and they file a 1065. LLCs can elect to be taxed as a corporation, but you have to make an election with the IRS. And if you're taxed as an S corporation, there's no double taxation, and it's not typically a taxable entity. No double taxation unless your accountant screws up when they file for your election to be an S corporation and files it the wrong way. Then you could end up finding out one day that you're a C corporation. So
yeah, by the way, you know why most of them are C corporations? Because when you file the corporation, I think that's the default. You don't have to make an election for C, do you?
Well, you have to make an election to treat an LLC as a C, and that's the big mistake a lot of CPAs make. Yeah. What they should do is go right to make the election for an S corporation for the LLC and avoid making the C election, because if something goes wrong with your S election, then you default back to a C corporation. There's nothing you can do about it. So,
you know, we're making a complex issue. We can make a complex issue real simple. You're a
Yep.
B S corp, simple as that. That's your default S corp. Anything else, let's find out why it's being recommended to you.
and you'll see my last bullet point here is LLCs can elect to be taxed as S corporations, but why jump through the hoops? Just be an S corporation from the get-go. Have your lawyer form a corporation, elect S status, and do it that way. And most alarm companies have few shareholders, so the 100 shareholder limitation on an S corporation isn't going to affect them.
No, let's not go there. We don't have 100 shareholders.
Yeah.
What is involved from changing from a C corp to an S or LLC? A lot. You'll have to contact Mitch. That's a whole nother hour, I think. We don't.
You can do it, and the rules to follow. And if you are a C corporation, you should seriously consider becoming an S corporation as soon as you can.
Yeah.
Because you can't for 5 years after you elect S corporation treatment.
Just check with me. I may want you to form a whole new corporation, and we're going to transfer accounts from one to the other, and that's the end of your C corp. But
so here's why
you can't do that with every sized company. So you might need Mitch.
Here's why being a single member LLC is a bad idea if you don't like to be treated as an S corporation. They report on Schedule C of the owner's personal return. So now if you get audited, the IRS has access to your personal return. So you get into what's called a fishing expedition. The typical Schedule C is a very small business. The typical S corporation is not. So even a small alarm company can push the boundaries of a Schedule C. And when the IRS is looking for somebody to audit, a company that's got high dollar deductions, especially for vehicles and for meals and entertainment, is going to rise to the top of the audit pile with the IRS, where an S corporation typically doesn't. So they're going to get a lot of scrutiny. Single member LLC owners pay self-employment tax on all of their net income. And so they don't have a limit. If an owner of an S corporation takes a $90,000 to $100,000 salary, the IRS will usually consider that sufficient and not tax the rest for FICA. I've seen guys that are taking $150,000 in income through their single member LLC and paying FICA tax, Social Security tax on almost every penny of that. And that's a problem. And if you are an S corporation, you can pay yourself a reasonable salary and not have that issue. But a lot of CPAs don't understand that there's underlying value in this RMR and advise you to become a C corporation. And that's a big mistake when you go to sell. It causes a lot of issues. So be aware of that. Are there any questions on this section, Kim? We're almost out of time.
We're all wrapped up. This is it. Let me just remind everybody that Mitch is available for private meetings that are free. All you have to do is contact Kathleen Lambert in my office. Check the daily emails. It has all the contact information. And Mitch will be there probably for the duration of the ISC show. If you're not going to be at the ISC show, please direct tax questions to Mitch, not me. If you send them to me, I'll be asking Mitch. So that could be the lazy way out. But if you go to Mitch, and also I guess if you come to me, you might not get charged by Mitch, but I'll get him to do a column on it. But if you have tax questions, you contact Mitch directly, and I urge you to engage him as an accountant. You won't be sorry. And Mitch, I want to thank you, and we're going to have to call it a day.
Well, thanks.
Thanks
everybody for the opportunity.
Mitch, you want to say goodbye?
Just say goodbye and email me, and we'll, if you have any questions, email me. We'll talk about how to move forward.
All right, we're gonna sign off now, folks. Thanks for attending, and we'll see you
Thank you.
next